Thank you for tuning in to the presentation of my capstone research project, in which we will be discussing the existence of contrarian returns from cross-listed companies as compared to companies only listed within the UK. Moving on with the agenda for this presentation, we will start off with a brief introduction for the purpose of the study, the key questions that will be expected to answer towards the end of this presentation, and the key dates upon which the event study in this project have been based on. Moving on will be a literature review for the most important papers that shaped the outlook of this presentation. Afterwards, I'll be given a brief market overview, both within the UK and outside the UK, as to compare both the performance of the companies within the UK and dual listed companies. Afterwards, for the methodology, we'll be discussing both the methods that will be followed in both our event study and portfolio balancing. And moving on, we'll present the event study results and the portfolio balancing results for the total holding period. And we will end with a brief list of the references used. So, as a brief introduction, what are contrarian returns? To understand more contrarian returns, we would explain what is a momentum returns and who are momentarian investors. A momentarian investor would think that any stocks that are overperforming in such a period T would keep on winning in the periods that are folding after. Hence, the contrarian would think the opposite, in that the stocks that have won in period T, the market will react and readapt to the prices, and such the winners in such a period T would underperform in period T plus 1, and in the opposite way, the stocks that have underperformed in a period T and were the losers in that period would end up actually overperforming in the period T plus 1. And a contrarian investment strategy is buying those losing stocks in period T and short selling the winning stocks in period T, and balancing the portfolio in the periods that come after. Cross-listed companies, it is as the name describes. These are companies that will be listed in two or more stock exchange markets to profit from the exposure and the opportunities in different countries. Brexit timeline. So a brief Brexit timeline is the whole Brexit talks started on the 22nd of February 2016, where the Prime Minister at that time, James Cameron, has announced to the the Common House, that there will be a vote to allow the population to vote whether to leave, for the UK to leave the European Union on the 23rd of June. That's the first initial stage of talking about the Brexit. And then on the 23rd of June, that was the date of the referendum where people have voted, and the results of the vote have came out that 52% of the voters are in favor of the UK leaving the European Union. This event have sent the country into like spiral of unpredictability as an economical and political crisis. Then afterwards, in October 2017, where Theresa May has won the chair for the Prime Minister, asked for the extension of an Article 54 of the referendum, where the exit of the UK from the EU would be postponed and delayed until a further period, which was March 2017. Then in March 2017, a deal was struck with the European Union that the Brexit would happen over a period of 2 years, which means on the 23rd of 2019, which actually did not happen, and it was pushed over until a later period in October 2019, where then the Prime Minister have changed, and initially it ended up being until the 23rd of 29th of Jan, where the UK have submitted their leave from the European Union, and that to be implemented at the end of the year of 2020. So in brief, the purpose of this study would be discussing the contrarian strategy and seeing whether there will be any contrarian returns from both the portfolios, one that is for the listed companies in the US and the UK, and then the locally traded companies in the UK, and see whether which of these companies, whether of these two portfolios was impacted the most by the Brexit. For the literature review, I have gathered papers that have discussed both the Contrarian Returns deal and dual listed companies, and the event study for the one that will be conducted for the Brexit. So starting off with Baker and McKenzie, they have found from a study based on 3 Australian dual listed companies that have generated abnormal returns from the cross-listing strategy, and on the contrary of the theory, the prices have measured in base currency have yielded higher returns than in theory. We have Ocher and Chan on 2030, which they have conducted study on Hong Kong Stock Exchange, and companies are listed in Hong Kong Stock Exchange in Netherlands and different EU countries, which they have concluded that contrarian returns yielded by this portfolio are actually insignificant, and the winners actually did keep on winning in that case. On 29, we had Abdi Young, Leonard Rosenthal, and Van Dijk, which they have found out contrarian returns did exist and actually yielded more returns than their local counterpart, mostly in countries within the European Union, which the companies were listed in between Netherlands, Switzerland, UK, and France. A later study of Ramya Cheng, Orioles, and Terence Hallan in 2011 have revisited the Ocher and Chan study and revealed that actually the contrarian portfolios of cross-listed companies, they actually did yield higher returns compared to the local traded companies by more than 4%. And also it was based on the Hong Kong Stock Exchange and cross-listed companies from that market. For the event studies, we have Brown and Warner in 1985, which was one of the first papers that have actually were based on event studies, where they have concluded that the usage of daily data might bias the OLS, which is the optimum least squares estimates. But even though the use of such daily data is more advantageous compared to using monthly data in scenarios where there is a high correlation and increased variance in surrounding the days that are surrounding the event. So daily data would be much beneficial for an event study than monthly data. We have Vikash, Hui, and Ahmad on 2016, which was a paper on the Brexit referendum deal and how it impacted different industries. It was concluded that different industries reacted into different ways, where banking, travel, and leisure industries were negatively impacted by cumulative abnormalities of up to -15%, while on the other hand, surprisingly, the tobacco industry have been impacted positively by more than 5%. One other thing that, as the Bank of England has predicted, the systematic risk has increased, which was seen across all the industries that were involved in this research. On a later paper, Bourne, Scholarek, and Sedlak have weighted the cost of the vote of the referendum compared to if it never happened, and actually the cost came up as the UK has lost already 1.3% of its GDP compared to if the vote have never happened, and also that the pound cost would increase further in the future due to this uncertainty regarding the Brexit policy, since every time it kept on changing and being delayed. Moving on to a brief market overview, we can see on the graph on the left the performance of GBP, the British pound, against both the euro and the dollar, and we can see that it has been immediately felt as the pound has weakened against the US dollar and the euro since June 2018 up to June 2017, where the Brexit deals started being pushed. And we can see also that every single time there was a discussion about the Brexit deal to be delayed, there was a huge fluctuation in the performance of the GBP against the euro and the US dollar. On the graph on the right side, which is for the consumer price index, it has been seen like immediately after the June referendum, the consumer price index has soared to the skies, and the inflation index in the UK before the Brexit deal and the Brexit discussions was 0.8%, and it soared up until a level of 2.7% in less than 1 year, which was higher than what actually the Bank of England has targeted, and they have targeted like 2% in the same period. This have increased the pressure on the households, and the inflation is expected even to reach higher levels if the Brexit is reached in terms of higher costs for the imports. Moving on internally in the UK, we have both the indices FTSE 100 and FTSE 250, which represent the performance of the companies inside the country. We can see that immediately in June 2016 that both the indices have plunged to an all-year level at that time because of the fears that of the UK leaving the European Union would undermine the company's operations and causing them to have lower returns. But the situation did not last very long, and within the year after, both the indices have recovered, but only to be impacted by the later UK and China trade war that started later on 2018. As for our methodology, for the search of the contrarian profits, which will be balancing the portfolios, monthly we will be measuring the performance of the stocks in each of the portfolios separately into two different dashboards, and ranking them from best to worst performers. And this we will be buying the bottom three stocks, which are comprising the highest losers and the worst performers, and then short selling the top three and the best gainers and best performers of the stock. And then the period after it would be rebalancing the portfolio and performing the same actions as to keep our portfolios comprised only of these stocks, a short sell of the top three, and then buying the bottom three to be sold in the periods after. For the event study, we'll be calculating based on a model in Excel the abnormal returns and the cumulative abnormal returns estimates on the selected dates that we have discussed in our introduction, which are the 22nd of February 16, 23rd of June 16, the 2nd of October 2016, and 29th of March 2017. And at each point we will be seeing was if there was any effect on each of the portfolios, and if yes, we will see which of the portfolios has suffered the more. Moving on to the data that was selected, the table details the 10 companies that were selected from the cross-listed companies, both in London Stock Exchange and New York Stock Exchange, and then the 10 companies which are only locally traded in the London Stock Exchange. We have tried to keep balance the companies and keeping them in the same industries. This way, they will be in mitigating any industry-specific event from affecting certain companies and not the others, which would make the portfolio not reflecting the actual case of the Brexit. For the abnormal returns benchmark, we have taken the market risk, which is the daily prices of the FTSE 250, and for the risk-free asset, we've taken the daily prices of the UK Treasury bills for 3 months. And the time period, we have extracted the data from Thomson Reuters Aecon, running over a period of 2 years from beginning of 2015 until the end of 2017. This way, it will cover the requirements of the event study model, which will cover 244 days prior to the event to incorporate all the signals happening before the date of the referendum, and then the second segment, which is the 15 days after the event, to make sure that if there is any late reactions or corrections in the markets are also integrated. From the graph, this is a graph for the performance of the UK portfolio. We can see that most of the stocks have actually felt a downward trend in their performance in their prices, except for DPH, which is Decra Pharmaceuticals, which have actually seen the prices of its stock shares which actually doubled. On the DLC portfolio, the loss is seen more than in the UK portfolio, where all of the companies except Rex, with Relix, have felt in loss in terms of the stock price. The major loser would be here that we can see as Shire PLC. The descriptive statistics for the DLC portfolio here would describe both the mean, mean, median, maximum and minimum values for each of the stocks, the standard deviation of each of the stocks. We can see from the skewness and the kurtosis is similar, and it's around the value of 3, which shows that the data is normally distributed. The skewness, they are neither right-tailed or left-tailed. All the values are approximately close to zero. We have the Jacques-Berat test for normality, and the probabilities are and the value are higher and closer to 2, except for one of the companies, which is Vodafone, which is insignificant in this case, and even the probabilities are higher than the 5% critical value, which and similarly for the UK portfolio companies, and which shows that our data is normally distributed and it can be used for the event study. We have run a unit root test for both the portfolios, and we can see that both the tables in the first red square, that we have assuming a common unit root, the null hypothesis assuming a common unit root, the t-statistic is higher than the critical value, and the probability is very insignificant, rejecting the null hypothesis. Similarly, when we are assuming individual unit root, where for the ADF, for the augmented Dick and Foley test, the t-statistic value is way higher than the critical value, and the probability is similarly as well insignificant. This can be seen both for the UK portfolio as well, where both assuming a common unit root and an individual unit root, both the values are high, the t-stat is higher than the critical value, and the probability is significantly lower than 0.05. Moving on to the event study, and similarly to what was discussed in the methodology section, we started by calculating the abnormal returns for each company by subtracting the expected returns from the daily returns. The first was calculated based on the CAPM model through the Excel using the intercept and slope formula taking into consideration the market premium. The average abnormal returns was calculated to derive the portfolio's abnormal return based on the average of all the companies, and additionally we calculated the cumulative abnormal returns for the 2, 5, and 10 days before and after the specific event to capture any delay in corrections from the market. The results here have showed a significant impact around the date of the referendum vote, which is the 23rd of June, but not much during the other dates of initial announcement, neither the extension of the Article 50 for the delay of Brexit during February 2016 and October 16 respectively. As shown within the red square, the following 2 days have seen a significant negative impact from the t-stat values and from the negative abnormal returns for both the UK listed companies and the cross-listed companies, with the latter being affected more than the first. The third and fourth day has actually seen an overreaction leading to an overcorrection, where the returns have actually been reversed and driven to a wealth creation position, but nothing has been much seen during the cumulative abnormal returns for 5 and 10 days. The results were mostly significant in the daily abnormal returns and the cumulative abnormal returns for 2 days. For the portfolio balancing part, we have ranked the top and bottom performers based on the change in returns from prior periods. And at the beginning of each month, a long position have been entered to buy the top losing stocks, which constitute the bottom of the ranking, while short selling the top winners at the top of the ranking. The position was then held for a month, and at the beginning of the next month, the same process was repeated by closing the prior period position and entering a new position based on the new rankings for the month. And for each month, a total return is reflected, summing the returns achieved for each portfolio, and to derive at the end of the investing period an average portfolio return for each of the dual listed companies and the UK only. This is an example to illustrate the ranking and return calculation process, as in the beginning of each month, a portfolio formed of each of the top 3 losers and the top 3 winners. Similarly, at the end of March, the return from the position is the change in return, which is reflected in the beginning of the month of April, which is the period T plus 1. Hence, a long position will be adding up the return or the change in return in April as the return position for March, and the short selling position is a deduction of the change in return for in April as a return for the position in March. This table here shows the returns from each position taken for the dual listed company's portfolio through each month. You keep in mind here that we have kept highlighted the same dates which have been discussed over in the event study to reflect the effect of the key events on the performance of the portfolio. Later on, we'll be comparing both the portfolios and the average returns and the total returns for each of the months. Similarly, this is a table that shows the return from each position taken during the 36 months period for the locally listed companies only within the UK. This is the comparison table, and from the monthly return in the left table, it has resulted that indeed the contrarian trading strategies have achieved returns and created value. And as expected in the beginning of the report, the dual listed companies have yielded higher returns than the companies listed only in the UK, with returns of 3% for the dual listed companies compared to 1.7% for the companies listed in the UK only. As for the referendum voting date in the month of June 2016, we can see that, as confirmed in the event study, the dual listed companies' portfolio was affected more than the UK only companies, hence yielding less returns in the month of June of 9.92% compared to the astonishing 29.88% in the UK, which can be resulted in the fact that outside the UK, not much investors have been affected or influenced by the decision of relieving the Brexit decision happening. This is a list of the reference papers and articles used during this presentation. I would like to thank you for enduring with me throughout the whole presentation, and I would gladly answer any of your answers throughout the comment section. Thank you for your